Hey, great. Hi, everybody. I'm glad that we're here today. Insurance, my God, insurance used to be one of those sort of, oh yeah, let's not forget about insurance. And here's the person that I know. She's a great insurance agent. And here's an independent broker, and go talk to them and let me know what we need to do. Boy, it's a lot more than that these days. And it probably has been for at least a decade, but it's more and more to the fore. So we are lucky enough today to be joined by Michael Baron and by I'm sorry, let me look at both of your bios. There we go. Victor Bull. Thank you very much, both of you. I have from my notes from last time your little short bios, and I enjoy them. So let me go ahead and introduce each of you. Victor Bull is a San Francisco native, born and raised. He went to St. Ignatius High School, SI, for those of you in the know, where he was not only an excellent student, but an accomplished athlete. He went on to university where he continued his athletic career, which happens to be basketball. Victor started in the insurance business as an auto claim rep. He continued in insurance, working 10 years for a family-owned State Farm franchise. In 2016, Victor Bull opened his own State Farm agency in his hometown here in San Francisco, the Victor Bull Insurance Agency, LLC. His agency does more than just home and auto. Victor's agents also broker personal insurance, commercial insurance, and retirement planning and mortgage loan origination. So that actually, the last part, particularly interesting for this group, right? Victor has a wife and two, it says young daughters, but someday that's going to be inaccurate. And they're going to be, if we do this long enough, Victor, how old are the girls?
One's turning 6 in October and the other just turned 3 in June.
All right, well, they certainly still qualify.
Yep.
Yeah. So thank you, Victor. I appreciate you being here.
Of course.
And Michael Baron is a fourth generation San Franciscan and a graduate of Tulane University. I note that because I almost went to law school there. Go Green Wave.
Go Green Wave.
He is in his 15th year as a licensed insurance broker for his family's business, Kenneth S. Baron and Co. Insurance Broker. Who's Kenneth? Dad?
Well, he's my father, yeah.
Okay. His roots in the business go back to the days spent filing, organizing, and learning the insurance business. Kenneth S. Baron and Company is in their 52nd year, and Kenneth S. Baron, Michael's father, I answered my own question, is still going strong. I hope that's true, since we were, yes, good. Thank God.
It is true, yeah.
Oh, okay, I'm gonna need to check with you next time on that. That would not be great. As a member of the United Valley Insurance Services Agency Cluster Group, Kenneth S. Baron and Company is able to combine the personalized service you would expect from a family firm, along with the market access and clout of a much larger firm, quote, end quote. Clients come first. And thank you both. And listen, just for everybody, we're going to learn some stuff. We're going to dive right into it. But I want to say that when I have insurance questions and concerns, these two have been incredibly helpful. And so most of the materials that we have here today have been influenced by what I've been learning, hearing from you, hearing from the California Association of Realtors. And then I go to these two in the field and say, hey, what's really happening? Okay. And so it's really been very helpful. So let's get right to it, guys. If we could, next slide will be your welcomes and your introductions. And Jen, if we could go forward, thank you. And then to the next slide. This next slide, I actually reordered. So the next several slides, I reordered, and you're like, why are we starting with the California Fair Plan? I mean, honestly, we're starting with the California Fair Plan because it underscores what's been happening. And so as these two will explain to you, the California Fair Plan is an insurance plan, a hazards plan, a fire insurance plan of last resort. It doesn't have everything. It is typically more expensive, but it is run by the state of California, but it has become more and more part of everyone's everyday needs. So, gentlemen, tell me what you're seeing, each of you, and we're going to talk in a little while about the difference between being in-house and being a broker. But let's start with you, Victor. What's happening with you? Are you having policies that you just can't write on? Are you sending people to California Fair Plan? Because you're with such a big name firm, does that impact what happens if and when someone comes to you and you need to send them on to the Fair Plan because you can't help them?
Yeah, that's a great question. So If there's traditionally, if there's a policy that I can't write and they can't, go to somebody else and the fair plan is the only option, I can't offer a portion of it. So the fair plan might be able to take care of the fires, but the liability that a homeowner may need, I still can't do that. So I'm sure Mike will touch on this, but they can probably piece together something in communication with the fair plan. You asked me, am I having to send people to the fair plan?
Yeah.
I'm having to send anybody and everybody away because in California right now, many probably know this, State Farm is not offering new policies. So that is something as simple as somebody buying a home, new homeowner, or somebody who's an existing client and they're moving out of this place they've rented in one unit down the hall to the next unit in the same building. It's a new policy. I can't even do that. So I'm having to send everybody and anybody away when I have to write a new policy right now.
And I got to think we're going to have some questions about what that's like and how that feels. One of the things on this slide that I think is important to note, I'm not sure if I knew this originally a few years ago when I created these slides, but the fair plan itself is limited to the fire coverage. It doesn't include personal property and liability. And so, Michael, you're an independent broker, meaning that people come to you and you are helping them find the right person to write for them, right?
Right.
And what's happening with you in terms of the fair plan and then these other subparts, liability, personal property, et cetera?
Sure. So we work with the fair plan on a regular basis, more often than we would want to. The fair plan is fire, it's vandalism, malicious mischief, smoke. It's about it. Then you have a companion policy, a difference in conditions policy to provide water damage as well as liability. The fair plan is, as I said, is being used more often. So it used to be that primarily we saw the fair plan come into play for wildfire zones only. However, the market has tightened up to the point where older homes now, homes in San Francisco with knob and tube wiring. I'm working on a home right now. Buyers are in escrow, bordering Sutro Hill, Sutro Mountain. We're putting that beautiful San Francisco home in the fair plan simply because it has knob and tube wiring and it was built in 1907. And so the fair plan is here. It is the insurance policy of last resort because the coverage is minimal, the cost is increasing, but more and more it is the only option. And so we're forced to use it. One thing that's important to know with the fair plan is just because you have a quote, a number, a premium does not mean coverage can be bound. And so it really is important that you make sure that your clients, when they tell you they have a quote, that it's an actual application that has been reviewed by the fair plan and not just a premium. I say that because escrow closes can be tight and the fair plan is running at about a week, week and a half, maybe 2 weeks to turn around an actual quote today. And so someone could be sitting on a number thinking they have a quote that they can bind, only to learn that it's really going to be another 2 weeks before they have an actual policy. And so just know that about the fair plan.
Well, let me just stop right there for one moment. So for the agents who are on the call, one of the things we're going to talk about in a little while, and will be prompted by some of the slides, is contingencies and contingency removals. One of the things that we did recently, and this is probably news to both of you gentlemen, is we changed the San Francisco purchase agreement, just the newest version that came out just last month. We added a new paragraph 25, which is a separate standalone insurance contingency. It's one line that says this contract is contingent upon buyer's approval of the cost and whatever, I forgot what the wording is, but the cost and effectiveness of an insurance policy. And so now the buyer has a set period of time, defaults to 15 days, right, to satisfy themselves. It had been, and it currently still is in the California Association of Realtors purchase agreement, part of this greater investigation contingency. And so the same thing that is all about finding out whether or not the roof works included within it insurance. And so now we have a separate insurance contingency. Important for everybody on this call to understand. Question in the chat: is the FAIR Plan acceptable to lenders if a home is not eligible for any other home insurance? That is a great question. Do you happen to know?
So it is acceptable to lenders. However, FAIR Plan's a bit tricky. They can either pay on a replacement cost basis or an actual cash value basis. Actual cash value is most often not acceptable to lenders. Lenders typically require replacement cost coverage. Now, the two things that need to be in existence for replacement cost coverage to be activated with the FAIR Plan: the roof can't be more than 25 years old, and you need to be insuring at least at 80% of the actual replacement cost of the home at time of loss. The roof question most often is answered easily enough. We more or less know how old most roof types are. We really don't have a way of making sure that a home is insured at least at 80% of the actual replacement cost, because that's a subjective term. We don't know what the replacement cost truly is going to be at time of loss. And so
Well, ironically, you would think it would be the quote unquote actual cost, which is the name of the other standard. So
when you say actual cost, right? So the cost that a contractor's charging to repair, rebuild the home, we don't know. You take certain high-end San Francisco home builders, they might charge $1,500 a square foot. You find another contractor, maybe out of Sacramento, who's looking to earn San Francisco wages, they might be charging $600 a square foot. So there's a lot of wiggle room there. My advice here is more coverage is better than less coverage. This isn't the place to skimp, at least not from a coverage standpoint and from a satisfying your lender standpoint.
Let me jump in with Victor for a moment. What about actual costs? So I know this was Michael's example, but I want to make sure you're in here too. So we have this home, a $2.5 million home in the shadow of Sutro Tower, and we're realizing that, okay, we need to use the FAIR Plan. We can't get anybody to write. What kind of costs are associated with the FAIR Plan? And as one of the agents writes in the chat, let's remember that in figuring out whether or not your client can in fact afford this house, we need to understand what these costs are. And I would also like to point out to the realtors that the finance contingency and the new insurance contingency are separate and apart. And so now that you have a new insurance contingency, it is not acceptable to say we didn't get the financing because of the cost of the insurance if we've already waived that insurance contingency. So don't waive the insurance contingency until your clients know exactly what they're going to pay, that they can afford it. That's what it's there for. The finance contingency is separate based on qualifications for the loan. All right, so let's talk about this $2.5 million house in Sutro Tower. If it was already on your books, what are they paying, and how does this compare to what they might be paying through the FAIR Plan?
I mean, if it's already on my books,
I know, big run.
$2,000 to $3,000 a year.
Yeah.
What I've and I want to be very transparent on this. If we're talking about the FAIR Plan, Michael's got to be the person to chat about
Fair
this
enough.
most.
Well,
but what I'm getting back when someone goes to the FAIR Plan, it can be 2, 3, 5 times as much, just depending on the different situations and the materials in the home or the roof, right, that Michael mentioned before. So but I am not going to be the expert when it comes to California FAIR Plan, because if I can't write anything through State Farm, I'm sending it to Michael, right? That's where it's going.
Why don't we move ahead? We're going to see some next questions, and we're not going to leave this, but you'll see when we move ahead, Genevieve, we'll go on to the next one. And the next slide talks about, and that's some information for you all. You can see that later. Keep going. And one more, some CAR resources. Actually, this one we'll just stop for a moment. CAR has a few good resources for us, and those resources include a whole website, which is set up to talking about a homepage for consumer materials for fire insurance. and then there's an insurance premiums soaring magazine article here, but then below is a whole Q&A that they have for you all on fire insurance. Okay, let's go forward to barriers to obtaining a new policy. Oh, actually, you know what? This one is interesting because we have the two of you here on the screen, right? And so the difference between the insurance agent and the insurance broker. And so, Victor, you're an insurance agent in this case.
Right. So I'm a captive agent. So I work with just one company, State Farm being that company, and I can only offer State Farm products, and that's really the difference. Whereas Michael, being a broker, he's still considered an agent, but they can go out and shop around through multiple carriers that he is licensed to do so through.
And even though you are captive, so to speak, and let's just pretend for a moment that your company does open up again and starts writing new policies, which I presume it will at some point. Either those policies or the ones that are currently on your books may not have all the coverage your client needs. And so now the question is, if they need a rider, so to speak, right? Do they have an opportunity, and do you have relationships with others to write these riders?
Right. Yeah. Most of the time we can add on endorsements, which is just adding into the existing policy, or separate riders if we have to, whether they need more coverage to protect their assets from lawsuits, whether they are renting the home out versus owner occupying the home, or doing both, where they rent portion of the home and live in the other portion. So we do have pretty much all the options to make sure that someone is holistically taken care of. But sometimes, for example, I just had somebody come to me and need a builder's risk policy. They're going to do a whole remodel on the home, and the lender said the policy needs to say builder's risk on there. Well, the State Farm policy does not, unless it's a completely newly built home, we do not put a builder's risk endorsement on our policy. We just cover the materials as if they're part of the dwelling coverage in the home. We don't add anything extra. It's just going to be covered. But if that lender needs to see that verbiage, I have to send it somewhere else, which I recently did in Oregon, because I'm also licensed in Oregon. And so I did send that to a broker because I couldn't take care of that. Once they're done with the remodel, if they want to relook at the insurance, I can always come back to it, but that's the situation.
Appreciate that. Michael, anything to add? If not, I'm going to ask about an HO6 policy.
I really don't. That was a good summation of the differences, and essentially insurance agents, one company, brokers, several. So we have a good stable of insurance companies that we work with. When you come to us, you have a general understanding of what the market as a whole is doing.
So, and I know it's a different policy in HO6. It's not really a rider, and it isn't an endorsement. But when we are usually referring to HO6, what we're referring to is a condominium and coverage that is part of a greater association, which includes a master policy. So we have a master policy typically that covers the structure itself, and the HO6 policy, which covers, typically we use the words walls in as a reference point to say, okay, the flooring, the cabinetry, et cetera, the rebuild. Then there's some other things there that are important. The where do I live while it's rebuilt policy, and typically a personal liability policy if someone slips and falls inside the house. Victor, are you guys no longer writing those as well?
That's right. We're no longer offering new policies for that. We're not canceling anybody. We're renewing everything, but we don't offer new policies.
All right.
Yeah.
And Michael, actually, Genevieve, go back to the barriers. We're going to stay there for a little while. Michael, where do we stand with the HO6 policies? Have they seen these increases that everybody else has seen?
Yes, so HO6 policies are increasing in cost. We're certainly writing HO6s, or write them every day. Knock on wood, I'm writing them every day. It will depend. So I see in the comments this particular HO6 was built in 1890. It depends. What updates have been done? How much coverage are we asking for? What type of building is it? Short answer is yes, coverage can be provided. The unknowns are going to determine which company and how much cost.
Joel in our questions asked the difference between admitted and non-admitted insurers. And I think that is such a good question because I have absolutely no idea. I don't even know those terms. So, gentlemen, what is the difference between admitted
Sure.
and non-admitted? And do I need to add a slide?
That is a good question. It's
Yeah.
a question that I'm dealing with daily. Admitted companies are licensed within the state of California. They're highly regulated. The Department of Insurance tells them if they can sneeze or not. They can't do anything without Department of Insurance say so. Non-admitted companies are usually going to be offshoots of or subsidiaries of admitted companies, but they are not regulated in California. And so these are the companies: Lloyd's of London, Scottsdale, Asgard, which is Berkshire Hathaway. Scottsdale is Nationwide. Westchester, Chubb, Pure has a non-admitted. These are the companies that are going to be most likely to say yes to homes located in fire zones, wildfire zones. And these are the companies, because they're not regulated, they can charge a premium that they feel justifies the risk. And so this is where you'll see your $75,000 premiums for homes in Napa, St. Helena, Calistoga, that kind of thing. Homes that are too big for the FAIR Plan, but are located in zones that are exposed to wildfire. And so you really find yourself in a bind when the home is in one of these locations. Surplus Lines says no because the risk is that great, but the home also is too big to fit into the FAIR Plan. Remember, the FAIR Plan has a total insured value limit of $3 million, which that's home, that's property, fair rental value, debris removal. All of the coverages cannot combine to exceed $3 million. In California, that's nothing. That's not even, that's not enough coverage.
And so,
this is
so that may also be your barrier to purchasing in the first place.
absolutely
Because if you're purchasing with a loan, right, that's a real issue. If you're purchasing for all cash and you wish to make this determination on your own, so be it. You can decide whether or not you're going to even have insurance coverage and whether or not it's adequate. But if you're purchasing with a loan, the FAIR Plan is only going to work for, I don't know, properties typically up to a couple of million. Yeah.
yeah.
Okay. All right. So that's really important to remember as well. And that's, hey, that's a big deal. There's a lot of properties you just cannot purchase. One of the things that's interesting here, by the way, is, and this is for the realtors, is often we have in Northern California, we're big on this concept of disclosure packets. We're learning everything we can about the property up front, and we're making them available to a buyer even before they walk through the door for their first open house, if they want to know about the property. This is not the way it works in Southern California, for instance. But we like this proactive approach. You need to be proactive as a listing agent and consider what the buyer's ability will be to purchase insurance. And I'm about to talk about homeowners associations. And so if your client is selling a condominium and you're in a homeowners association, it doesn't really matter how much they want to pay if they're going to get a loan and the lender is not going to approve the master policy. And we're seeing a real issue now in lenders who are scrutinizing the existing master policies and saying they're terribly undercovered, right?
Mm-hmm.
Either they don't have the right thing or they don't have the right amounts, or the physical condition of the structures, the condominium itself, the roof, who knows what, is unacceptable to us. And good luck getting the HOA to change any of that, right, in the 21 days that is your escrow. And so you as a listing agent really need to be proactive when you're selling in an HOA. Is the master policy going to work for someone with a loan? And then I think I would inquire too about their supplemental policy as well. And so in the old days, we used to have a lender at our open houses with brochures. You may want an insurance agent or broker at your open house with a quote for what can be expected.
It's a good idea.
Yeah. I'd also say anytime that you have someone buying in a condo unit and you're making the referral, or you're having that client go and talk to their insurance agent to get a quote, come with the HOA master insurance policy come with the CCNRs and give that to that agent to review holistically, because I'm not even writing them now, but I'm still reviewing them for people who are referring to me, because it's so important to understand where that policy is supposed to stop for the building or the master policy, where the interior policy is supposed to pick up. And I'm sure Michael does this because we've talked about this kind of stuff before. I think we're on the same page. I do not hesitate to say, hey, you need to go back to the president or the board and confirm that even though the CCNRs say the building policy is supposed to go inside the units, is that what everyone on the board agrees to? Are you operating under this way? Because you need to have an understanding when you're buying your individual insurance on what you really need. And the banks are just checking off their boxes.
Right.
You know, your lender is just checking off the box. Do they show proof? Sometimes they don't even say. I ask them many times, how much coverage do you require to make this loan go through? They say, oh, we don't require any amount. We just need to know that they have insurance. So it's so ambiguous that you need to get with an insurance agent who's going to look at it holistically for you.
Yeah.
So one of the frustrations Sherry Howe tells us in the chat is that she tried to get a preemptive insurance quote for a duplex that she had coming onto the market soon, and was told that from a few different insurance companies that they wouldn't even give a quote without an actual buyer name. Can we just fudge that and say I'm the buyer? How much?
I mean, so I mean, what I need for a quote typically is a name and a birth date, so I can look at the loss history of that client.
Oh yeah, that's
if
important.
you know, because it's just like your credit score, your
Right.
claim history follows you. So with State Farm, we don't care about the property's prior losses. We care
Right.
about the client's losses. Other carriers, and Michael might have more to talk about on this, care about not just the client who's buying, but the actual property. But for me, I need to know, does this client have any losses on record? Because that will impact whether or not they're even insurable. That's separate from whether or not the property itself is insurable.
So it's so funny, Michael, before you jump in here, that's what's on the screen. And that's one of the things that you guys taught me a few years ago, which I didn't understand. And so it's like in car insurance, right? It isn't necessarily the car that's being insured. Sure, a Maserati is going to get insured at a different price than a Toyota, but it's the driver and the driver's claim history, which I found very interesting. And so what we have on the screen now is barriers to obtaining a new policy, buyer considerations, and at the top is the claims history, not of the property, right, but the claims history of the buyer. Next is hazard zone, fire, flood, quake. Well, we're used to these government maps, right, and we all think that, oh, it's in this thing. But as you two explained to me, that's not the standard that the insurance companies use. The standard that the insurance company uses are their own maps, right?
Exactly.
So let's just underscore that for a moment, people. So you're assuming that because we're looking at the NHD report, the JCP report, and we see that it's in a certain zone, that's our issue. The insurance companies are looking at a much more granular level. Not only do they have maps, but it's the address. And what's interesting, and I learned, is that it may be that for one person, that address is fine, but for the neighbor, it isn't. And it's not because the neighbor's property is necessarily any different. It's because they don't wish to have all of their eggs in one basket. And so oversaturation by the insurance company just in that neighborhood is going to be an issue. And so they need the address, right, specifically, and they also need a name.
Yeah.
Did I get that right?
Yep, that's exactly right. And a good example, Safeco has been insuring in San Francisco for years. They've been closed for the past 6 years in San Francisco, having nothing to do with wildfire. Their saturation reached a point where reinsurance said, we don't want to touch any more San Francisco because they were worried about fires after earthquake. And so Safeco, you may have read in the news, they're actually non-renewing homes in San Francisco right now for that very reason. Insurance companies do run clue reports, which is claims history. Some insurance companies, Chubb, for example, will take into consideration claims occurred at a home, maybe even another home, in relation to the buyer who's buying whatever home they're buying. And so not all insurance companies do that. claims that happened at the site before you own the home can be counted against you. It's important then to know if you're going to get a preemptive quote in your name, it's going to be based on everything but the claims history of the buyer. And that's going to be an important fact.
You know, what would be interesting would be if you had this. So let's just pretend for a moment Sherry Howe had decided, okay, I'll use my own name, and she happened to have a claims history, right? The irony would be that she would be showing a quote that may actually be extra high. Right?
Which wouldn't necessarily be a bad thing. If
Sure.
you want to be, if you want to err,
Right.
err on the side of too high. It's always easier to come down.
So let's stop here, because this is one that has been on everyone's lips for quite some time now, is physical characteristics of the property, right? And so we're trying to get a new policy written, and we've already talked about two things, which is the age of the roof, right?
Mhm.
For some people, and knob and tube wiring is going to be the other question. And so I have purchased several homes in San Francisco with knob and tube wiring, and I remodeled a few of them and took it out. I purchased homes in San Francisco with that notorious Federal Pacific whatever
Stat
panel,
block.
Yeah.
right?
Circuit
And
breakers.
and in one of them, it needed to be replaced before I could close escrow. And the other one, I had to make some promise to have it done within some period of time. So let's just stop here and flush this out. So physical characteristics of the property, and let's talk about both canceling policies based on them, the ability of an existing policyholder like State Farm, and a requirement of someone like State Farm to check. Are they looking at their inventory, asking if they had a 25-year roof policy requirement, and that roof was 20 years old at the time they placed the person there 10 years ago? Are they now looking at the records and doing the math and saying 10 plus 20 is 30 and
Yes.
requiring something, right? So, gentlemen, let's focus on this for a little while, because I guarantee everybody wants to hear the answer. Victor, let's start with you and State Farm.
Yeah, so most of the time when you're setting up a new policy through State Farm, there isn't an exterior survey done. When you get to properties that need to be insured at above 5 million to rebuild, then you probably will have an exterior survey done. And if that exterior survey shows that there's shrubbery too close to the property, the roof has some shingles missing and needs to be taken care of, there's signs of dry rot, they will give you, even though you just set up this policy and it shows that it's in force today, they will give you 30, 60, 90 days. Usually it's about 90 days to take care of that. Or if you can't, because it's hard to get a contractor, and get this taken care of right away, or material issues, what we've been able to do is, here's a signed contract with this roofer, with this contractor, for the work to get taken care of. Okay, we will continue to keep the policy in place, but you need to show proof by the next renewal that this was done. And they are following up on these non-renewals because of those physical characteristics of the property.
Now, is this, Sherry asked in the chat here, is this the loss control survey that she is experiencing? So she's listing this 2-unit building, and someone has come to do a loss control survey, apparently related to the existing policy. So I guess that's the big question, is what you just spoke to sounded like it was a new policy, right? But
Right.
what about existing policies? What's happening with companies like State Farm and existing policies?
Yeah, it sounds like the loss control survey to me sounds like it has to do with a claim that may have happened, and they want to make sure that it was taken care of, whatever needed to be fixed. But I don't know specifically. That's not the term that State Farm's using. So Michael, you might see that more coming from your carriers.
Regardless of the term, right? Let's just ask about, State Farm and the other big carriers. Right. So obviously you all are averse to risk more so than you have been in the past.
Mhm.
And so are you all looking at your quote unquote riskier policies and requiring some physical inspection and then canceling?
We are not. There are some exterior surveys that are going out for renewals. Nobody's canceling outright without giving somebody time to make a repair. You can't do that. But
And are these the
it's
kind
not
of
happening
repairs?
very often.
What are those kind of repairs? So
It's usually fairly simple things like trimming trees and shrubbery back from properties that I'm seeing the most of. Sometimes it is like this roof needs to get taken care of, or there is dry rot, or there's a board. Simply, there's a board on the side of this window. Why is this boarded up? You need to take it down and show photos that you've removed it and anything's been repaired. It's not happening too often for State Farm, at least not with the clients that I have, because most of the properties just aren't in poor conditions. But I do know it's happening more from other carriers, and Michael probably can touch a little more on that.
Yeah, Michael, so jump in there and then throw in the knob and tube and everything else.
Sure. So loss control surveys are definitely happening in the market generally. They happen, that's another term for an inspection, that's all. So insurance companies will inspect directly following a new policy being issued. Pretty much everyone is doing this that we work with. And
Okay, so
then
let's just make sure we understand that. They're inspecting after the new policy is issued.
after the new policy is issued, that is the final underwriting. That's the final underwriting hurdle, yes.
All right, congratulations, you've closed escrow. The insurance was 3 times what you thought it would be. And now within some period of time, 30, 60, 90 days, the insurance company is coming out and doing an inspection.
Exactly. And that's where they're going to pick up things like trimming trees, tree limbs away from the roof. If concrete in front of the home is cracked, it's a trip and fall, they're going to want you to replace that. That's where they're going to pick up on the Zinsco Federal Pacific circuit breaker box, knob and tube wiring, all of the requirements that they need in order to justify staying on the risk. That's where they're going to pick up whether or not the home truly definitively meets the requirements. Now, what we're seeing also—
So let's just stop there for a minute. Whether the home truly meets the requirements. So is there somewhere when I buy as a buyer a list of these requirements? And if I read it carefully, I would know that, hey, if they do come back and they find knob and tube, et cetera,
No. Essentially, that's for the agent broker to let you know. Look, I pretty much know what all of my companies want. The X factor is knob and tube wiring can be hiding in the wall. I asked the question, people may honestly not know if their home has knob and tube wiring. And so then it's a judgment call as to how best to proceed. But insurance companies are now conducting loss control surveys at renewal also. The home qualified last year. Does it still qualify? Is it being kept up in a way that we feel comfortable continuing to insure? So if this is a duplex HOA, it's very likely that the insurance company is inspecting annually to make sure it's something they want to continue with.
Okay, so scary, interesting. What about foundations? So I'm curious about foundations. We have a lot of brick foundations in the city. Is that on their list, or is it more of the fire issues?
Brick, so foundation is definitely on the list. It's going to be more of an issue with open post and pier foundation. So if you have a concrete perimeter, generally speaking, you're fine. If you have brick as a portion of your foundation, it's unusual to find a fully brick foundation today. You could be okay depending on which insurance company you're going with. Some insurance companies are teamed up with the California Earthquake Authority to provide earthquake insurance. Those companies are probably not going to care about a brick foundation. They're still going to care about open post and pier. Those companies, Travelers, Chubb, Pure, that provide their own earthquake insurance, they are going to care about foundation type, and they're going to care about level of seismic updates. Pure won't accept any home that has not been updated since 1997. Chubb just needs it from 1945. Travelers is just a thumbs up, thumbs down based on the location of the home. They don't really care about updates. They care more about seismic activity in the specific address and soil type. So foundation's less of an issue, but it certainly can be an issue.
All right. Before we move off of the physical characteristics of the property, agents, do we have any other questions about this particular concept? Barriers to either a new policy or getting canceled as a result?
I've seen some questions about knob and tube come through, and these are questions that we're dealing with on a daily basis. No knob and tube is acceptable, none, zero. Traditional, we bought our home 2.5 years ago, the very first thing we did, it was built in 1923 and it looked like it didn't have any electrical updates in the last 50 years. Called an electrician, we rewired the entire home, put in new lighting. That was the first thing we did when we moved in here. Insurance companies want no knob and tube.
Yeah.
So if you have a knob and tube listing, the fair plan is where you're sending your client.
Exactly. Surplus
the buyer.
Lines wants no knob and tube.
Say that again?
Fair plan.
I'm sorry, say that one more. So the fair plan is the answer. for knob
Yes,
and tube.
exactly.
And the issue there is, one, it's expensive, and two, its coverage is limited. And so if we do have a lender, we may have a serious issue because its coverage may be too low given the value of this home.
Potentially, but you can usually work the fair plan to become acceptable to lenders.
Right.
All right. All right. Any other
Better, you'll
questions?
be better off just getting it replaced. I mean, it's
Exactly.
gonna eventually it's gonna save you money on the insurance. It's gonna be a safer situation. It's gonna give you more options.
The
Yeah.
problem though is, if I'm a buyer, that sounds great and I love this house, but the seller is the one who's killing me here, right? Because they didn't get it changed, right?
So what we've been able to do is show intent to take care of that knob and tube wiring or that stab lock. And so you have the electrician write out the proposal, and you sign a contract saying you're going to start the work on this date as soon as you take ownership of the home. It's been okay with our underwriting team. It's pended for a non-renewal if we don't show proof that it was updated by the renewal time, but that will allow us to move forward and offer an insurance policy.
Yeah.
Interesting. Michael, you've seen that?
Most companies we work with, they want nothing to do with it. They're not looking to write new insurance, plain and simple. They
Right.
don't want to be adding new exposure to their books, no matter how clean it is. And so this is just something they're using to say no.
Yeah.
Okay, that's incredibly important. All right. Let's go forward a few slides. A lot of this we've covered and our time is short. Unique wildfire challenges. Well, I think we've talked enough about this. We certainly know that the maps are important, but it isn't necessarily the maps that we all see just as important as the insurance carrier maps themselves, right? It isn't necessarily a zip code thing. We also have the issue with more than, eggs in one basket, right? So let's go forward again. Flood, I just want to stop here and say, I want to make sure we understand, and you all taught me this. If there is a rainstorm, and whether we call that a rainstorm or a hurricane, if it causes a bunch of water, which comes therefore from the sky to the ground, and then from the ground up into the house, if you don't have flood coverage, you don't have coverage for this.
Correct.
If instead, in that same storm, it knocked a tree down, which put a hole in the house, and then the rain directly fell into that hole, congratulations, you have coverage.
Yes.
Right.
That's the difference between flood coverage and not flood coverage, okay?
Correct.
Use
Next
the word
one.
rising, the term rising water.
Water.
Rising water is flood. Yeah, tree knocks a hole in your roof, you're covered. And forget the tree. Maybe you just have a leaky roof. That's covered too. Not the roof, but the damage done by the water into the home.
I like the not the roof part. That's a good point. So otherwise there'd be incentive to let your roof go until it leaks.
And this is the
Right.
problem the insurance industry is seeing. Replacing a roof can cost $30,000, $40,000. People aren't looking to do that. So they have let their roofs age. So especially this past winter, we had a tremendous number of water damage claims arising from roofs that should have been replaced 5 years ago. And so what many companies are doing now, this goes back a slide or two, they're using satellite imagery. I'm sure you've all seen the news article about AAA and their drones. Pretty much everyone is using satellite imagery to just get a baseline look at their roofs that they're insuring. And what most companies are doing are saying, hey, it looks like your roof might need to be replaced. have a roofer come out, take a look at it, and then if you don't do that, then the cancellation comes. You can get a pretty good idea from looking at Google Maps what condition someone's roof is in just by eyeballing it.
And so I hate to plug my own business, but I'm opening a roof painting business where we paint little lines vertically and horizontally. In which
I'll be your first customer.
You have brand new shingles, and for $2,700, we will do that to your client's roof.
Yeah.
And then we put a little finger on the thing for the
I want to say something before it leaves my mind for those agents out there who have homes in San Francisco and California of a certain value. With State Farm being closed and other companies being closed, Chubb and Pure are going to be your pretty much only options. Travelers used to be, they're not. Mercury used to be, they're not. You need to have your clients do the bare minimum seismic updates, or else you are not going to find a buyer that's going to be able to buy insurance on that home. CalQuake is a great organization. They'll come out, they'll inspect the home, they'll do bolting, whatever. It won't be that expensive. But I'm talking about a home with a replacement cost of maybe 3 million and above, 2.5 million and above. They're out there, they're old, they have not had updates. In order for any buyer to find insurance on those homes, seismic updates are going to be a must.
One unanswered question on the knob and tube and the process of inspection. So who's doing these inspections, right? So we get the drone for the roof, I understand that. We get a drive-by, I get that. But how are they discovering the knob and tube? Say it again.
They ask the question. It's an application question. Never used to be. Today it is. Is this home equipped with knob and tube wiring? Yes or no?
So they're asking that of the applicant who is a buyer who may not know.
Yes.
Interesting. And they're taking their word for it?
Well, then they go out and they inspect.
Wow.
Well,
but again, knob and tube wiring could be hiding. It could be hiding.
So when they inspect, are they sending someone inside the house?
Yes.
And they're looking in the garage clearly, but are they opening any walls?
Not opening walls, but they are poking their heads into attic spaces.
Right.
No,
Garages
not
and
opening.
attics. All right. Maybe they'll open a junction box here and there.
Oh,
Okay.
absolutely. Yeah.
All right. All right. That was flood zone. Let's see what's the next slide, Genevieve, please.
Well, can we go the flood zone thing?
Yep.
I want to just mention something there. FEMA is not the only option.
No.
I get people asking me for flood insurance, and I just send them to Michael. I've just said, hey, can you offer a better policy? Because flood insurance is only going to, through FEMA, maximum $200,000 of coverage to rebuild the structure. That's nothing. If you want to just satisfy your lender, FEMA might be okay depending on the cost of the policy, but you may be able to go through a broker like Michael and find a policy that is cheaper than FEMA and provides more coverage, or provides more, whatever you want to do, but it is not the only option. So I typically urge anyone who's looking for flood insurance to go find it through someone who can offer more than just that FEMA policy.
Yeah, flood insurance is some of the easiest insurance for us to place. Lenders get up in arms over it, but it really is very easy to place. The cost might be an issue depending on where you are looking to buy, but flood insurance should not be looked at as the hurdle that many people do look at it as being. It's an easy thing to procure.
Yeah.
Appreciate that. I was just making some notes and updated my slide. Appreciate that. Okay, let's go on to the next one.
With the caveat, if your home is on stilts in Tiburon over the bay, that might be a different story.
Yeah.
What's an insurance commitment? What might it be withdrawn? So this is a little bit different from what we were talking about, but it sounds like The insurance commitment is the commitment before we write the new policy, right? It
Yeah.
sounds like typically what we're hearing from you all is that most of the legwork is then done after the close and not
Yes.
before. And so we don't necessarily have the situation where we get the commitment pulled out from under us. What we find out is that after we get in, that the requirements may or may not be met and some work needs to be done. Is that fair?
Yeah.
Yeah.
One of two things can happen today, and this has happened. We get underwriting approval from an insurance company to issue a home. Maybe we're 4 weeks out, 3 weeks out from escrow. And then that insurance company decides, we no longer want to do business in California. And they rescind the approval. So that has happened. It doesn't happen often, but it can happen. Or we get the approval, we bind coverage, escrow closes, then the inspector comes out, and now we have a laundry list of things that need to be done, and the homeowner simply either can't afford the changes, doesn't want to make the changes, and so the policy gets canceled and we have to scramble to find a replacement. Of course, now it's more difficult to find a replacement because we have a cancellation that we're dealing with as well, but
That's
I would
interesting.
say there is no commitment.
A cancellation is a black mark against you, like a foreclosure?
Absolutely. So the question the other insurance companies always ask, have you been canceled, non-renewed, whatever? And the answer is yes, then it's why. Oh, because I have tree limbs touching my roof. I have too many redwood trees in close proximity to my house. I have concrete that's trip and fall. I have outdoor stairs without a railing. Those are all reasons that the new insurance company are going to use to decline to offer coverage.
I think I would tell them I was canceled because my wife was too nice and sent them too many chocolate chip cookies.
I love it. I love it.
That would be my reason. What about, and so in the chat here, we have a question about non-residential policies. And so what that reminds me of is for our agents, a typical non-residential policy would actually be a multi-unit policy or a renter policy. Sometimes that's a rider to the existing policy, and sometimes that's wholly different coverage. So let's just jump on there rather than straight commercial. I don't think we're going to cover straight commercial today, but residential properties that are not owner occupied, that are rented, what are we seeing there and what's unique for us?
Nothing good. I've got a 3-unit building I've been working on Taylor Street for the past 4 months. They haven't had insurance because their surplus lines canceled them for knob and tube. The fair plan, for a variety of reasons, is giving us grief over the building. And this property owner is actually paying $85,000 to rewire his tenant-occupied building, which in San Francisco is a pain in the butt, opens you up to wrongful eviction, harassment, all of those issues that come with doing work on a tenant-occupied building. It's difficult. Farmers, we're getting a lot of referrals right now because Farmers is non-renewing pretty much every tenant-occupied building older. Some people have told me it's older than 1950, others 1970. Yeah. Some others 1925, but of course those older buildings that haven't been updated we can do it in most cases, but it's not going to be adequate coverage and the cost is going to be between here and the moon. It's difficult.
So I'm shaking my head, as is I'm sure every agent here, right? So I don't know the average age of a home in San Francisco, but it's older than me, and I'm not exactly and I now can buy senior housing, right? So not good. And so one of the questions here is, to what extent, and this is a big holistic question, I know, but to what extent is this the fault of our insurance commissioner or California Department of Insurance? I don't know that is today's topic. Let's save that one.
That recording symbol scares me to answer that question.
Yeah, that's a good one. All right, we're going to save that one for another topic. I promise.
There's a lot to be said. There's a lot to be said on that topic.
I think that needs to be a CAR webinar, right? California Association of Realtors with their lobbyists, right? And then with somebody from the Department of Insurance.
Yeah.
We'll save that for another day. We'll try to get that. for
I'll
everybody.
say this because I think this is okay on the recording. We've all been paying fake rates in California.
Right.
They have not been adequate to really make sure that insurance carriers can continue to make their promise to their policyholders to pay out on claims. So you can expect for companies to be able to come back into the market and offer policies in California, you can expect 20, 30, 40, 50+% increases on premiums. And 20, 30 is probably the minimums that they need to on their current policies that are in place. 50 and above is probably what needs to happen on anything new coming in.
Yeah, the wildfires, pandemic, auto losses, all of these things created the need for insurance companies to increase prices. California's unique regulatory body is preventing us as a state from being able to cope with that pricing need in a reasonable way. And so we're the only state in the union that is facing this trouble. Even Florida is not quite as bad off as California. And it's because of how our Department of Insurance is set up. It's different from pretty much every other state. And California, once again, is unique.
Well, I would say that, by the way, Florida, my God, things are not going any better there. And so typically people are paying more in their insurance in Florida than they are for their mortgage. So things are not exactly going well there. I just put in the chat your telephone numbers. I hope that was not wrong, but there's certainly going to be some people here who would love to contact you directly. All right, we have 12 more slides and we are at the end of our time. So in the interest of saying this was really very informative and leaving them wanting more, why don't we just open up I don't know if we can do it, but Genevieve, if we could always open up the lines and let people ask a couple final questions and then call it quits. Is that possible?
I would have to let one by one in. So whoever has a question, just raise their hand and I'll let them.
Yeah, if you want to raise your hand and ask a question, you can. Otherwise, our last anonymous attendee asks, not sure if you've covered this, but the insurer on a recent house my client bought required an automatic leak detector and water shutoff. Water shutoff is interesting because I'm used to gas shutoff. I didn't know about the water shutoff, plus a smoke and burglar alarm system wired into a firm that monitors 24/7.
State Farm.
Within 45 days of close, State Farm. This sounds like somebody who's not really, you know what this sounds like? This sounds like I don't really want this client so bad. And so if you want to work with me, it's a 12% list fee. And if you do, great. If you don't, so be it. I mean, that seems like what's happening here. Yeah.
Yes and no. I can tell you the reason that they need that coverage is because they have $2 million or more. And I know if it's new, they don't have more than $5 million of coverage to rebuild because we capped our coverage at 5 million this year, but they probably are going in with coverage at 2 million or above. And that makes it a requirement to have all those things. But water, surprisingly, we talk about fire damage and these wildfires. Water damage is a huge claim issue when a property has water damage, and those leak detection systems can figure it out and shut it off, and it's going to save insurance companies so much money. So it's not so much that they like, oh, I'll do it if you know that they don't want to do it, but they want to make sure that they can continue to keep their promise and pay out on claims.
Exactly. Chubb is going to require pretty much all of this on every policy they write. Pure, same thing. The water shutoff system is only, in my experience, a requirement if you've had a previous water loss and you need to show you've done something to prevent future, or if your home is of a certain size, 5,000 square feet or more, that's where that's really going to come in. But this is going to be status quo for a lot of insurance companies. Essentially, they're saying, look, we're putting up millions of our dollars here. We need to make sure that you're doing everything you can to protect your home and our investment.
let me ask you one last one, a little tip from Mr. Hershkowitz here that I see as a risk manager. So from time to time, we will be asked by our clients to help them find a tenant for their property. And hopefully we're saying to them, oh, well, before you do that in San Francisco, that's a big deal. Go talk to a landlord attorney because there's blah, 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 blah. Right. All right. But when we do realize that our client is no longer living in the house that we put them in, and now they're looking to sell this house, one of the questions we should be asking them is, did you talk to your insurance agent to make sure you have the right coverage? Right. And so I would really think for all of us, that is both a nice talking point, because you're always looking for talking points, but also super important for your client to actually realize whether or not they have the right coverage. Often someone will get a policy, they will have that policy, they will then decide to move on and up to another home. And if they get that new policy with another agent or carrier, there may never have been a discussion about, wait, what about the old place? What are you doing with it? I'm now renting it. And so do you have the right coverage to protect yourself and to protect the tenants and protect yourself against the tenants if the tenants make claims against you? All right. So we have some shaking, nodding of the heads. Much better than shaking. Nodding is good. Okay. All right, gentlemen, there's only one thing to say today. Thank you. I'm declaring this officially a success. Victor Bull Insurance Agency, LLC, State Farm. You can find Victor at Victor Bull SF, victor@victorbullsf.com. Michael Baron, Kenneth Baron Insurance Brokers, M Baron, 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 at ksbco.com. Baron at ksbco.com. Seriously, I was worried for a moment that you might not be showing, and I was thinking to myself, oh, I could do it if they're not here, it'll be okay. Hell no, I could never have done this if you were not here. Thank you both so much. Super informative as always.
Happy to do it.
Victor's email one more time, Victor at victorbull, BULLSF.com. What a name. Michael, it doesn't matter how much you know, you're never going to be Victor Bull. My God, what a name.
It's true. It's true.
Yeah. All right. Thank you, everybody.
Thank
Appreciate
you.
all of you.
Of course.
Bye.
Good to be here.
Bye-bye.
Bye.
Bye.